I would say three things to your generation, okay? Three recommendations. The first recommendation is to think about your savings. And the best way to think about that is to think, how much money do I spend each month? And how much money do I have saved? Because savings in that is freedom and security. The second thing is, what should I put my saving in? And when thinking about what you should put your saving in, realize that the least risk investment that you think from volatility is the least risk investment, which is cash, is the worst investment over a period of time. And number three, if you're going to play the game, it has to be the opposite of what your instincts and the crowd says, because the market reflects the crowd.
In this video, I'll break down Ray Dalio's investing principles and strategies so that you can make consistent returns no matter your portfolio size. I'm Marcus de Maria, chairman and founder of Investment Mastery. With over 23 years of stock investing experience and a decade of teaching proven strategies, I'll show you the key lessons that Dalio used to build long-term wealth, and I mean wealth. What shaped Dalio's unique investment philosophy? Well, Ray Dalio realized early on that the economy moves in cycles, swinging between periods of growth and decline. And this shaped his all-weather portfolio at Bridgewater Associates, his hedge fund business, which aimed to minimize this volatility across market environments. The key insight was that assets like stocks, bonds, and currencies respond differently to conditions. This is called inverse correlation, or in plain English, when one zigs, another one zags. For example, if interest rates go down, the stock market tends to go up. So by diversifying, Dalio developed his balanced all-weather portfolio, as he calls it, resilient to shifts in the economy. Dalio's deep understanding of the global economy allowed him to correctly predict Mexico's 1980s financial crisis, when most others did not, showing that he could spot risks and opportunities that many missed. This expertise to see the big picture played a key role in Dalio building his $17 billion personal fortune. Now, when researching potential investments, Dalio takes a very data-driven approach. He analyzes investments using historical pricing. We can do that. Financial figures, we can do that. And economic indicators to predict market directions. He also famously advises, don't prematurely bet against hot trends. And this reveals core insights. For example, follow momentum. Even when trends don't seem logical, markets often continue in the same direction longer than expected, right? For example, in the 1990s dot-com bubble, it kept inflating far beyond reason due to speculative mania trumping sound judgment. And this reminds me of legendary trader George Soros, who famously said, if you see a bubble forming, jump in. Interesting, right? Next insight. Resist betting early against surges. Dalio learned firsthand from his own and other mistakes that attempting to time market tops is difficult and risky. For instance, many questioned the accelerating housing prices in the early 2000s, but were punished for shorting too soon, well before it crashed in 2008. And finally, study historical cycles. Remember, Dalio believes big up and down moves in the market tend to repeat themselves over long periods. So by looking at old stock market crashes and surges, he could often tell when prices were driven too high or too low by hype. He would measure these cycles to predict when investments were overpriced and ready to drop, or undervalued and about to rise again. And this allowed Dalio to make winning market calls by going against the crowd. Now, similar to buying shares, Dalio lets practical strategies steer his selling decisions too. So, if an individual stock seems clearly overpriced compared to financial measures, he may kind of trim those heavy positions to lock in existing gains before possible pullbacks. If some picks become too successful, outgrowing ideal portfolio balances, he rebalances by selling portions of those outperformers and shifting money back towards the lagging areas. And this maintains balance rather than letting a few bets dominate. Also, serious weakening in a company's core business or industry prompts reducing exposure there. Major economic shifts require adaptations too. For instance, rising interest rates may necessitate adjusting holdings in rate-sensitive sectors versus those that benefit. Dalio focused more on shares of large consumer brands like Procter & Gamble, Coca-Cola, and Walmart. These tend to sell steady products, commonly known as consumer durables, even in recessions. And this makes sense, doesn't it? Because people will still buy shampoo and shower gel no matter what. And this is something to remember when you believe a recession is coming. Consumer durables, remember that. Dalio also bought more overseas emerging market stocks. And listen to this, the S&P 500 index funds, which is so surprising and also inspiring. And what they're really doing is spreading money across sectors and also different countries to help soften the blow if US consumers pull back. Definitely something to think about, as most countries will have an ETF or an exchange-traded fund of their country's top companies that we can buy into. Amazing. So, Dalio put more money into defensive, diversified picks able to weather economic storms. And this matches his all-weather philosophy of being ready for different market conditions. Now, let's dive deep into his current holdings. In Starbucks, would you believe? Starbucks, he sees immense future growth as rising Asian incomes make branded coffee more accessible. This captures powerful demographic shifts, so keep your eyes out for brands gaining new global customers. And Visa. Dalio recognizes the enduring trend towards cashless payments as commerce moves increasingly online. This identifies durable secular changes, so make mobile payment platforms part of your portfolio. Think about MasterCard as well, or maybe American Express. In Costco's loyal customer base, have you heard of Costco? He finds revenues resilient even in varied economies. This represents stability despite shifting conditions, so seek out subscription models insulating against dips. I have to say, my local Costco is ram-packed. And for general US market exposure, an index like the S&P 500 ETF or exchange-traded fund provides broad diversification. I still can't get over that one. This balances his stock picks as he blends in index funds to balance risky bets. I mean, that's something we can do immediately, right? Now, this one may be controversial for some of you at least, but Dalio also invested in the emerging digital currency Bitcoin in 2021. Though the exact sum remains undisclosed, doesn't sound too controversial to me. Dalio recommends a 1 to 2% Bitcoin allocation, citing its long-term potential while accepting the volatility. As someone who made almost $10 million from crypto, listen, I'm not surprised to see Dalio strategically embracing this next-generation asset. What's controversial is that he only made 10 million profits. I mean, come on. His fund is worth many hundreds of billions of dollars. And watch this space as Dalio makes a lot more money in cryptos over the next few years. So, how can you apply Dalio's proven investment principle in your own portfolio? Well, first, study economic cycles. Dalio realized economies swing between growth and decline. Understanding those patterns can reveal the next market direction. Next, diversify across sectors. Blend assets like stocks and bonds that react differently to conditions. This balance minimizes volatility. Also, stress test investments. Map out scenarios to see risks beforehand. This aligns with Dalio's data-driven analysis as opposed to just gut feeling. The key is balancing risks smartly across the portfolio rather than chasing maximum returns. This fits Dalio's central philosophy of having an all-weather portfolio. That's interesting, right? Instead of chasing maximum returns. Interesting. So, what's the most important investing lessons that you've learned from Ray Dalio?